Alright, hello guys, and glad to have you on board again today. I will record these weekly updates specifically outside of TradingView, just to avoid being pinned to the 20-minute video limitations that I have out there, because there are plenty of things we need to talk about, and I'll need all the available time. So expect kind of a half an hour long video in here, because we've got things to talk about. We had a quality candle close, which means the weekly contexts are updated. And we have some new things to discuss. So we're going to start rolling over to the S&P 500 as kind of a global macro vision. But of course, we're going to scroll through multiple other asset classes to see how they updated accordingly. So in that perspective, S&P first. And boy, we start right away. The weekly context has shown reversion. So I'm going to start immediately rolling this one out. The thing is that from what I've seen so far, some other users of the indicators who are looking at some different underlying assets, I don't know, CFDs or whatever, don't have this reversal. So to set things real straight, the reversal pinpoint is very, very much narrow, and it has been reached on my chart, might not necessarily be the case on yours. The indicators are very sensitive, but at some point the differentiations can be dramatic at some point. Just look at what you have in front of you. To make it plain simple, what I do here is not telling you what the future is made out of. What I'm doing in here is just doing in front of you my long-term risk limitation. As always, the fucking things I talk about, I do have trade expositions to them. So I mostly just put my money where my mouth is. The thing is that I put my money according to what my indicators show me. And like I said before, sometimes if you have a look at different assets, underlying assets, tiny differences can make significant changes to the indicators. Net over time, they will come to close differentiations, to pull out those differentiations and come close to each other. But the thing is that for a limited amount of time, they may show different signals. So TLDR in here, trade what you have in front of you. The indicators don't know the future. I don't. You don't. No one does. So the thing is that don't try to seek truth from the indicators. They are meant to do just one thing: help you contextualize your markets and help you risk manage when you are in a speculative area. Don't trade what you see, follow the goddamn strategy, and don't try to play God. Most importantly, if you and I have different signals, trade the ones you traded before. Don't change in the meantime to just figure out whatever most suitable situation looks like to you, okay? So no personal appreciations. That's definitely why I created those indicators. It's okay? So you probably will miss on some opportunities someday because of the differentials. But the thing is that it will save your ass if you just have consistency in trading, okay? So I had to make those warnings first, okay? Some of you may not have these reverse contexts, and in that perspective, you don't give a fuck about what I'm saying today. You keep on applying the previous plans you had, depending on whether you were trading the same contexts, of course. So reversing the weekly does one thing to me, okay? Of course, I need to contextualize my market because now I have an opposite direction for the context and the moving average. Most importantly, the moving average is below the preceding rising context, which means I was in a trending market context, okay? Whether that was the primary trend or not depends on whichever context I'm looking at. So I need to look at the higher time frame to make sure that the trend isn't there. And the trend is there. We have a rising moving average that is rising slowly and slower than the context does. So the trend is in the monthly trends, it is a monthly chart, okay? The breakout definitely has been in here. So we're bullish until we at least get something close to a pullback. And if we ever get such a thing, then that doesn't nearly mean the trend is over, okay? So try to understand these things. We still have plenty of upside potential in the S&P 500. Those who call for the end of the world, good luck with them. They generally are more proven wrong than the opposites. Well, like I said, I'd rather like to be proven wrong with indicators and risk limitation rather than just following narratives. So anyway, the weekly chart isn't the primary trend, which means all that we're left with is just to know that when contexts are opposite to rising moving averages, then the only thing that we're going to get is a third range boundary, and whatever we do with it depends on the primary trend, okay? So we don't try to fight in here. We just know that if you're a bull, well, no worries. We're going to get to the third range boundary sooner or later, okay? So the third range boundary requires at least 61% retracement, and we're currently still trying to find the bottom. That doesn't mean this is in. We still have 3 days to go for this weekly candle, and even though this one looks great and has some signals, it isn't closed yet, okay? So we need to be patient, and we need to have a confirmed price reaction. You have the price okay in here saying that we're nowhere but close to get a triangle pattern, okay? But so far, this current price action isn't suitable enough to consider that the dip has been made. So we need further confirmation to find the weekly bottom. In order to anticipate these things, expert traders, and only do this if you know how to fucking do this, I'll go 2 to 3 time frames below to try figuring out reversal pattern structures, which I'm going to try doing in front of you today, but don't replicate, okay? The thing is that back then, I was trading on a daily range context because the weekly context was going up. And in that perspective, the daily was the largest range I had available. This range was freakingly mature as we had 5 and then finally 6 range boundaries into this. The range was mature, reached its target. The third range boundary was right there. Or how to say, maybe it was there, or God knows. Anyway, both are aligned. So anyway, this range was bearish, it was mature, and we've reached the targets. The thing is that once the range is mature, you stop overthinking things and you go for damn range trading, meaning that you put your goddamn fibs and you try not to make things too smart, okay? You try to just be as dumb as possible by doing just one thing, okay? Not ever selling there. This is buy only when you're in the gray area. This will be sell only when you're in this area, and don't try to make things even more complicated than that, okay? It's really not that complicated. So the daily chart was a mature range, and we were waiting now to get to the dumb boundaries or to break them, okay? But now that the weekly chart is reversed, these things are changing because now the range is in the weekly range, is in the weekly time frame, which means the reverse that I could study would be 4-hour and 1-hour respectively, okay? Therefore, I need to try figuring out what are the boundaries for this thing. This thing isn't a range, so I cannot put my fibs into all of those areas, okay? So the thing in here, like we stated, is we're generally going to have to use different types of Fibonacci's because the worst we could get in here is a pullback, okay? Now, in that perspective, we will use different types of fibs. Generally, standards are minimum 23%. In trending context, anything that is less than 23% fib retracement is just pointless. So this was the first speculative area. 38% is going to be the next one. 50% will be the last one because, of course, below 50% retracement, we're going to have a problem. We rarely retrace more than 50% in trends, or we have a problem. So this is where our new speculative areas are, and that is a mandatory step to clear. You don't move ahead with trying to figure out reversal pattern or trading flows on lower time frames if you don't define your speculative areas first, the areas in which you will not trade other than one side, okay? So out of those Fibonacci's, it was bull only. So this was bullish only area. No one would be dumb enough to sell back then. Same thing goes when we'll get closer to 50%, okay? So this is the thing we need to do first, okay? We need to clear out the speculative areas. In these areas, not possible to sell, okay? So this is really what this is all about. And then we go 2 or 3 times below it. 2 time frames means we're going to look at the trend channel. 3 time frames means we look at the context, but this is basically the same thing, okay? So it's just that this one has a much broader vision because we can see the overall context. All right, so in here we can definitely see that there's no 4-hour flows. The moving average, yes, is going down, but prices have been oscillating across. So if there is a flow, it's going to be 1 hour. This is where we've got significant enough moves of prices to get the context to shift away from the moving average. And congratulations, we've done it there and there. So this is where the flow is. This is where we can study reversal potential. Though in that perspective, if the range is now extended to weekly, then we need to figure out the third range boundaries alignment patterns. Though, like I said, if you don't know how to do this, don't do it alone. This is reversed context trading. This is expert level, okay? But I'm going to just do the TLDR for you here. The thing is that, though we've got a first flow, created this third range boundary, gosh, we've just squeezed it. Thank you, Jay Powell. But the thing is that, well, the market just flushed all the way across this level, okay? We've just gone straight line down, straight down, all right? Though the thing is, this is where I've took my first speculative entry in the blue area and so on. I mean, anyway, even in a daily chart context, this was an available area. So I tried buying this signal. And then, of course, I waited to get some other ones. And then I got a second entry here and a final one there. Average entry price is in here. And I'm now back in profits. But I'm back in the resistant context, meaning that my trades are confirmed. But the thing is that I need to risk manage. So, of course, first things first, I get this trade out of the table with a tiny but still a profit. And I took a little bit of profits from the bottom twos in here so that I could eventually get out of risk. Meaning that now, if the market goes down and breaks my entry points, my average entry price, which is somewhere near there, then I'm gonna get out. Okay, so I've paid for my stop loss down to the current bottom. Meaning that if prices go back to 38,600, I'm out with no risk. Meaning I take no loss. I paid for my loss. All right. So that's really how I've decided to do, because like I said, in these areas, this was no selling back then. Now we clearly broke below, though this is now a resisting area. Okay, so this is an area in which bulls need to be cautious. We broke through that level. So we really want to be cautious with this area. Until further notice, this is a resistance area, meaning this is an area for the sellers to do their job. Though for the buyers, this is where you risk fucking manage, okay? When you're a buyer, you don't turn out to be a seller the next day, okay? You don't do the switching things. You just, if you're a buyer, you risk limit on those areas. So like I said, I've just lowered my average entry price and lowered my risks by taking some fucking profits, okay? So that's the thing. If we're in a weekly overall structure, I'm going to pay attention to a third range boundary structure. I never pay the second third range boundary because normally trend flows tend to pull their motions into odd numbers. 3, 5, it's generally 3 most of the time. So we've got one third range boundary, first flow, second flow with its second associated third range boundary, meaning that if we reverse the context in here, we're going to go back there. And this is where the bears, okay, those who will be trading in these areas eventually, or those who still have traded bear trades before, they will lock on their gains. Anytime there is a third range boundary, this is where their profit take, meaning that buying in here is very risky though, but possible still. I will eventually see if I'm willing to do it or not, but I already have traded these areas. So this is more like I'm going to hold my previous trade and see what it goes. If there's a full range boundary that is still trading below the falling moving average, I think this will worth taking my profits off this game. If the market flushes down, I will accept being stopped out at no loss normally. For the sellers, this is where you want to short sell the fucking market, okay? If you think the flow is about to continue to get to trade into the 50% area, which is 3,500, then in that perspective, selling 3,800 and the like is going to be your area of preference, okay? This is where you're going to try to short sell the market to target this area. Like I said, I agree with everyone. You might have a bullish bias or a bearish bias. There is something to eat for everyone now. The thing is that just don't be a switcher. If you were a bull, then risk fucking manage in this area. That doesn't mean getting out, because if we cross over this area, that means this was a fake out. And we've just never should have broken that. We're going to recover it as a support, and then we're going to recover. And the first target we do after a fake out to the downside, we generally fake out to the opposite direction. So once again, TLDR means we're going to fuck up that resistance if we go up, okay? So like I said, if the market goes bull again, the bears are going to take a severe hit because they're going to be chased and taken down in a single straight line kind of move, and we're going to go all the way up there because this is where the last stop losses of the bears are, okay? So remember that if the bulls take over this area again as a support, that means this was a fake out. That means this was a trap for bears, and we're going to go immediately taking down their stop losses, okay? Though crossing the moving average and going straight up to the volatility boundaries and taking down stop losses right after. That's one scenario. But of course, in a resistance area, resistance holds out of resistance as long as it's been broken. So for now, I would say, yes, we might have retraced very quickly, but we did it in the past as well, and that didn't prevent Powell to just come and wreck the market. So in that perspective, it could happen again. Though, bulls have to risk manage in here, partial profit taking depending on your risk assessment. And in that perspective, like I said, I've got taking profit patterns, so this is not necessarily an emergency action, but I think taking profit patterns means you have to take some fucking profits, okay? Just don't be a bull without safety belt, okay? It's really what this is all about. If it goes down and creates a third range boundary, then that's exit fucking signal for the bears. That means whoever has bearish action in the market needs to profit take. And they will have to sell again, possibly on the moving average, and take some risks. In here, they will have to sell, depending on the risk limitation they will get back then, and they will have to risk take, meaning that if the market breaks, they're going to have to take some stop loss. If the market flushes down, then they're going to take a profit, and I'm going to buy the next third range boundary. Remember, I buy odd numbers of third range boundary. I don't buy the second one, well, tiny amounts in short-term trades, but I'm going to definitely be all in for this one. If there is 3 third range boundary, moreover, if they are aligned, technically speaking, you know I'm going to be there to take the money. So the thing is that I don't know what structure we'll have back then. This is really like 3 or 4 steps ahead of the market. So as usual, have your plans, but let the market decide. So for now, all I can tell on the shorter time frame perspective is that tomorrow I'm going to look at the context. If the context is reversed, that means the third range boundary is coming along the line. Whether I'm going to buy it or not depends on whatever technical signals I have on the third range boundaries. I'll probably give it a take, but like I said, I'm going to have to be cautious because as long as we're below that area, this will be resistant. This is an area in which the bears will fight for their goals. Their goals is eventually to pull us at less right down there or eventually even lower than that, okay? Now, like I said, have a sequence. For a reverse trader, understand that either this is a fake out and we're going to have to straight line up and recover this big red area as a support and get to trade above, okay, and go immediately taking down the bears. Option number 2, this wasn't a fake out, and in that perspective, the weekly range that I have now officially in front of me may extend for a third and final third range boundary sequence afterwards, and if that's the case, then that's the one I'm willing to risk take on. Though, just to balance the risk, okay, if the bulls have been wrong-footed in here and if that's a fake out, then there is a lot of upside potential to cover until we go back to neutral. If this is not the case, then of course there is an equal balance to the downside. So where's the equilibrium? If we are straight up, then this is where we're headed. If we go down, then this is where we're headed. So where we are now is 50-50 game. That's the usual thing. So this is where the battle plays. This is where there's likely going to be some ranging activity for both camps to fight each other, okay? So I don't expect a harsh reversal with the same old Powell coming and fucking everything up. I just think we're going to have to range in here and assess for quite some time because I think both of those areas that we could target as both bulls and bears are pretty much far away. Just to give it a glimpse of this, that will be a 10% up move or a 10% down move, which is quite significant. Okay, so in terms of stock market, we're done now. It depends mostly on what you have in front of your charts. If the weekly context has reversed, and if you are trading on those weekly contexts, then something has to be assessed. There is a probability of an extended final move to the downside after ranging. Though what we would expect now is a range, but there is a significant probability of one more downflow to occur. And if that's the case, then that means you must be ready to take on those losses, temporary losses, and or get out to get in again. But like I said, selling or selling to buy again later is a pretty bad strategy if you're trading above the weekly chart time frame, okay? The range is going to be 1 hour chart reference time frame, meaning this is more for experienced traders to balance their risk on shorter time frames. So it's all a matter of reversal. Like I said, in a reversal experienced pattern type of thing, I think there is a probability to get a third range boundary. That means we might have technical opportunities to go lower before going higher anyway, okay? But this is a matter of risk managing when prices do this, and we're definitely not yet there at that time. Okay? If the market rebounces anyway, like we said, we're going to have a resistant third range boundary on the weekly chart in here, and that coincides with the area that we've said before. So where we are now is pretty much halfway through the game, but the longer picture still favors the bulls. So you don't really want to be a bear now. It's very dangerous. The only way this thing could be bearish is if it goes from bullish to bearish in a straight line, which is not technically viable unless the markets have been excessive, and there is no reason. This is not a market excess. Like we said, the monthly chart is trending and there is still some more to come. So in that perspective, you might want to be a bear, but like I said, rather like to be short term. I see some bearish opportunities right up to 4-hour charts. Anything on top of 4-hour is not for the bears to trade. So try to be reasonable. If you're a bear, trade on the time frames in which bearish activity is doable. Okay, that's for the stock market. Then of course cryptos, boy, we still have a lot of things to cover in here. Weekly charts, nothing has changed because of course everything has been settled by the previous quarter in terms of cryptocurrencies that were like 3 months ahead of the stock market. As you know, risk, whatever bullshit, and liquidations in the crypto market. Still, the market in here is firmly fucking bullish, okay? We do have opposite context and rising moving averages, which means range is due on these time frames, and there's no more than that, okay? So this is a range, and as we can see, the moving average is rising. We're still trading above it, meaning that this range can be no more than a trending range. In that case, we trade anytime the market tries to go below the moving average, and moreover, if we're trading above previous resistances, aka the overlap. So we're definitely in an area in which, gosh, if you're bearish, good luck with that. Those who are selling in order to eventually buy at a cheaper price, good luck with that. I've seen that happening so many times. The market surges to the upside, you're fucked, and you're going to have to buy at average prices afterwards. There is critical supply on Bitcoin, so double warning in here. If you're a long-term hodlers, and if your long vision has always been 3 years and ahead, boy, don't be dumb enough to sell at 20k to just try grabbing it back again at 12k. I've seen so many people doing it, and they are still waiting today. So in that perspective, understand that you just don't want to be the one that buys the cheapest prices. You just try to do the best possible job and think about value, okay? Those who want to get the bottom are generally the ones who will end up buying the mean. And that's history that told me this the hard way because I've been there before, okay? So once again, don't be dumb enough to try catching the bottom. It's not the case. When you're value trading, whichever it is that normally you should be doing in the weekly reference time frame, there are no weekly trends without value. Though if you're trading the value of those cryptocurrencies, boy, don't think about catching the perfect bottom. This is exactly the #1 strategy of losers who will end up buying the average prices later. Okay, so in here, like we said, we're in supportive areas. So no matter whatever the fuck you think about, no selling activity can be done in here. It's buy mode only. The question is, of course, if this is where the range is, then we have 4-hour flows being eventually at play. And this is where the same old situation comes into play. We do have huge flows in here in the 4-hour charts, okay? So that's the same old thing. Remember that, okay? If we do trade 4-hour flows, that means we're in monthly ranges, okay? Which we do not. In here, to be honest, I don't nearly think that's the case. So what we need to trade is a set of 1-hour stuff, okay? So for 1-hour time frame trades, that's the same as we do on Wall Street. And as you've seen, Wall Street has been pulled out 2 downside flows, and oh, congratulations, we've got the same one in here. The thing is that, boy, this is much more bullish than it sounds to me because we haven't succeeded breaking the bottom now. So there are totally different situations in the crypto markets than we have in the stock market. And that is something really, really interesting and important for you to think of. Those who think that the crypto market will have to wait for a confirmation from the stock market, whatever bullshit, don't get me wrong, we have different technical situations, so if you make that stupid assumption because an analyst who don't trade is saying so, you'd rather like to follow your charts, okay? You'd rather like to be proven wrong on your own rather than listening to someone who doesn't trade. So really that's one thing to understand. Trade what you see. If the range is in the weekly chart reference, which it is, then in that perspective, just have a look at the monthly. Okay, though the monthly is eventually going to change, but it's going to wait until the end of the fucking year. Until then, we have a rising moving average and a rising context, so boy, don't be dumb enough to anticipate these things. Till the end of the year, and that's still 3 months from now, things could radically change. If for whatever reasons crypto surge by the end of the year, this context isn't going to reverse. And I know this because I've made those fucking indicators. So I know whatever security is in here to prevent the indicator from reversing this context. And I can tell you that if we just go back to 50K by the end of the year, which is definitely fucking possible, then in that perspective, those who will trade to the downside, like I said, those who sell to buy cheaper, whatever, are going to be the same ones who will buy at 50K by the end of the year because there will be too much FOMO of risk of getting out or whatever. They are definitely bullish guys who are just expecting to get a better entry price. Like I said, don't be dumb enough for this. You rather like to take the risk of buying 20K and holding the possibility of this going down to 12K rather than selling in order to buy at 12K. Because in one of those two assumptions, there's one in which you know the future. There's another one in which in a couple of days we could rather like be at 30 plus, and it could really happen fast. Remember, we're less than 15% available supply. So if anything goes wrong, you're fucked because there's going to be lots of slippage. So remember, understand that prices can surge very quickly in limited supply availability. If it does, you're fucked because most of the time you won't buy at 30K. You will say, well, this is just one of those rebounds, fake out, whatever. The market's still going to 12K. And remember that I exactly know how these psychologies are driven because that's exactly the devaluation pattern I told you about. The market goes straight line down for whatever stupid reason, and it will recover straight line up for the same opposite reason and just go back to the mean, where, of course, you will convince yourself that, well, we're never going to go to 12K, so I've got to get to buy. Like I said, pay attention to these devaluation pattern. There's highly psychological management in here. And the fact that there is a huge dichotomy in terms of structure between the stock market and the crypto market, that this one basically has a quarter of anticipation over the stock market. Well, if the stock market goes one leg down, that doesn't mean the crypto has to do one leg down. Crypto can just stay there, or worse, they can go bullish right when the stock market goes bearish. Of course, there's a synchronicity between those two markets, so don't let me tell you that this market will still have synchronous cycle, meaning that one can't go up when the other goes down. But the thing is that different amplitudes can create totally different things. We will have synchronized cycle, meaning that both can go up, but the stock market fails to retrace much higher than what we've seen before and gets flushed severely afterwards when we get something that is close to a retracement in the crypto market. Next cycle goes up when this one is just barely retracing. We got a final leg to the downside, and this one is barely consolidative. And in the end, bam, the stock market rushes to the upside and catches up on the crypto market, who has fucked every bear who thought it was going down. And in that perspective, listen to me carefully. Like I said, we can go lower. There's definitely some similarities and some signals in the stock market that says there might be risks out there, and those who play the correlation game may take that as a situation in which the crypto market may make another lower low. And I understand that. I just see this as a possibility. But the difference is, don't ever think that you know the future. Most importantly, if you're willing to buy over the long term, if you're buying the value of cryptos, boy, 20K is the overlap of 2018. It's definitely a good area to buy. Don't try to be smarter than the others and trying to catch the bottom. Whatever the fuck that is makes no sense. We have some tradable signals on the bottom of those weekly range. If you wanted to buy crypto on weekly charts, buy it. It's really not worth it to expect getting $8,000 discount per Bitcoin just because you're going to get more. I know how these things plays out. I don't mean I know the future, but I know that the statistical odds are definitely closer to 50-50 than you think. You might think that there's more chances to go lower, and I can definitely tell you this is really not the case. This is 50-50. And if it goes up, you'd rather like to be ready to buy in a rising market, because if you're not, you're going to wait and it's going to rise again, and you're going to wait and it's going to rise again, and you're going to end up buying at 45K. Though, like I said, hear me well, Okay, that doesn't mean you can do halfway through it, meaning that you buy a little in here and you save a little just in case we go 10K. I would understand that strategy. But those who are all out the market now with expectation to go all in at a cheaper price, boy, you really, really don't understand how market works. The thing is that a market doesn't go down to go catch up on the buyers. I mean, this is just TLDR. This is rule number one of liquidity. We don't go down to find buyers because most of the time we get the same buyers at the average price. So we generally just go back to the average and then the same ones will buy anyway. So just try to be smarter than that. There could be their correlation between the stock market and the crypto market just due to the same reason that the crypto market has fallen before the stock market, but most importantly, the charts are not the same. They might be the same when we get a monthly reversal, meaning that we need to wait till the end of that year in order to confirm that. Until then, you're trading with your guts. And like I said, this can be very, very dangerous. I personally will not shift my odd on these strategies until 31st of December. All right? I trade what I see. I don't trade what I think. And I see a lot of people right now who do the opposite. And that's very dangerous. That was another warning, but that's it. For crypto, we're done. Now, if we go on to the macro side of things, because of course, everyone is scared the fuck out of what Jerome Powell is going to do, then as usual, we're going to have a look at this. The weekly context updates, and here we are. Not that fancy of a change, okay? We have unfolded context boxes in the bottom, which means yields are rising faster, but it's not the case on the resistant context. So I would say we've broken in here, we've gone preemptively rate hiking stuff and so on. The very aggressive part of the yield curve has been priced in already. In my personal opinion, we're not now rising enough to keep on the pace of 75 basis points. And the weekly chart says there's still room to the upside. Remember, rising moving average and rising context says we're looking for more upside in here than downside, and prices will have more chances to go trading above the resistant context than before. So I think this is the target for the next quarter, to try trading above 4.20%. But it also means we've got 3 fucking months to get there, and it's not going to be an easy task to do in the short run. So the thing is that I personally think that we're going to shift up those things, and that means by the end of the year, if we can get to 4.20 on the 10-year yield, that means the Fed can do no more than that. And I personally think that the Fed has no more room to go by the end of the year than 4.2. And this is something that we're going to have to study over week over week, but the tendency I see in here just confirms that. The Fed is not pivoting anytime soon, but the Fed can't raise rates at a 75 basis points per mandate, as people may think it is. Currently, if we look at the data says we're 50-50% chances on the 2nd of November meeting to get a 50 basis points or 75 basis points. I'm just going to show you the... Okay, these things have changed today, quite severely actually. We've got an increased, this was like 50-50 earlier today. So now it's shifted to 66% to get a 75 basis points. So we'll see all about that. These things changes on a day-to-day basis, but this change is quite significant. So we'll see all about that. But now the market is pricing in 75 basis points, where I just said clearly the 10-year yield says the opposite. So we'll see if the traders are getting this one wrong eventually. Another thing that we need to talk about is this overnight repos. Overnight repos have finally started to shift down, and we finally broke a previous day's bottom. So we'll study this over the course of the next few days. But this is, and this might be the sign that the market is finally moving all that cash in the market. So that could be a sign that the market is eventually reversing. But like we stated, we've got very much something to eat in both cases. We do have some signals suggesting a little bit more downside potential would be possible. But in the opposite end, we do have some signals that we're already past the worst of the rate hike cycle in the US, that there might be some rate hikes in the rest of the world. ECB and someone might be catching on a steep pace as well. But for the Fed, the 75 basis points might be behind us. Of course, we're going to need confirmation by the 2nd of November. But until then, things are suggested that way. If we look at the data itself, that will be looking at this. Remember that the Fed looks at the core PCE only. They don't give a fuck about the rest. And they're looking at a quarterly basis, semester basis, and year over year. And someone nice in the Discord has been building this thing for me with the raw data, so we can study all of those things. This is basically whatever the fucking Fed is looking at, and that's great, because all we can see all across the board, we've been taking increases, though it's coming from 1% to 1.2 on a quarterly basis, 1.7 to 1.9 in a semester basis, and 4.7 to 4.9 in a year-to-year basis. Though in that perspective, this is kind of 0.2% all across the spectrum of yield maturities. But the thing is that this is not yield, sorry. This is PCE, rate of change. So the rate of change across multiple maturities is rising at 0.2 basis points, 0.2%. all across the board. But the thing is that, well, as usual, as you can see, these things go up and down, up and down, up and down. The clear longer-term trajectory is headed to the downside now, but there's, of course, a bit of uncertainty. Are we headed there and go all-time highs again, or are we going to go there? So there's lots of uncertainty of the next number that we'll get in November as well. So huge interest on the next core PC. If this one heads down, and if it's lower than 4.7, that's the confirmation that peak inflation might have been behind us. If, of course, we go higher than 4.9, that means higher than 0.5, then 5.0, then that means a big problem is ahead of us. The whole trend is kind of settling to the fact that there is lots of uncertainty regarding these numbers, because the year over year is going down, the semester over semester is kind of headed down in a more cyclical manner, and of course the more sensitive value, which is the cyclical month over month or quarterly over quarterly stuff, as you can see, would currently be in a hesitating state. Though this really is going to be an interesting number to look for the next month. It's going to set the direction, and definitely the Fed, if it starts to roll down from the very aggressive rate hike, I think the next PCE will be the game changer. All right, though back to the charts, and that now that we have this whole strategy, you understand that timing is going to be very severe across the next meeting on the 2nd of November, and most importantly, right after on the PC. Though I think the Fed is going to play nice and safe and probably going to go 50 basis points, because the 10-year yield markets is very tensed, and in that perspective, is pretty much not likely to give that much room to the Fed. So they're probably going to be a 50 points hike. But there's probably going to be a huge emphasis on the PCE number. If the PCE number is disappointing again, keep on going up on all of those maturities, then in that perspective, there's going to be a shock in the market, because that's going to be the sign that we're going to get another 50 or even more by the next meeting, which is going to be the 12th of December and the like. Okay, so very, very important timing. For the next quarter, the 2nd of November FOMC meeting might shock the market if, for whatever reason, the Fed is rising yields above, is raising the Fed target rates above the 10-year yield. That will be the sign that we're in recession. And going in recession is the sign that the Fed might be its final rate hike. Because remember, if we cross the 10-year yield, normally that's the moment in which the Fed is going to have to stop. And therefore, if we cross down, that's the sign of a pivot. That means that there's severe damage made to the economy, and that therefore the Fed is going to have to stop rising rates afterwards. Otherwise, we're going to get into unprecedented territory in which we got an economic contraction and a financial tightening as well, which we've never seen in history. But, I mean, there's a first for everything. Like I said, I could be wrong. I don't know the future. But for now, I'm following the previous cycle's study. And in that perspective, normally, the Fed should try to play this soft landing as long as possible. Okay, so until further notice, 10-year yields drive the acceptable rate hike style for the for the Fed, and they say, for now, I think that 50 basis points seems more reasonable. We also have to pay attention to this, which hasn't changed radically. In that perspective, this is neutral monetary policy stance, and I think we're going to oscillate across this. So still more rate hikes to come, but at a slower pace. So normally this should start to look more like this, but no more than that. So this should stop the markets from panicking, but also understand that those who think the Fed will pivot are definitely fucking wrong. Or at least it doesn't look like that to me. That's for it. Regarding the dollar index, we're gonna have to wait a bit more, because in here, whoa, weekly context are broken up and down, very excessive market. So in that perspective, if this really was excessive, we're gonna have signs of this, normally 2 time frames below. So the 4-hour chart is where we'll know. And boy, I told you in here that we were going absolutely outrageously stupid. We have volatility alerts. So let me be real clear. If there is no support for the dollar in here, that means there, and that's going to be hell of a wake-up call. That's not the end of the world, it's just a 10% drop in the dollar, after, of course, surging like fucking crazy against every other currency. So this means there are definitely some risks in the dollar. And I know some people now say, well, anyway, any other currency is fucked up, so the dollar can only go up. I'm really saying this really out loud, guys. I look at my technicals and I don't give a fuck about your narratives. All I see is that if this area doesn't buy in the dollar, you're fucked, because you're going to take another 5% dip, and it can be very freakingly volatile, okay? So pay real attention to this. We've gone excessive, and we can very much do the same thing the opposite way around. A maximum drawdown for the dollar still is 10%, because if we go there, you can be damn sure that there's going to be some rebounces out there, okay? So I think we've gone excessive. So two things can come out of excessive. Either we go one step further, meaning that this wasn't just a preliminary and we're going to go even more dumb and to the upside, meaning the rest of the world cracks down and everyone goes to dollar. Like I said, this is a narrative. I disagree with that. I might be wrong. And if that's the case, I'm going to take some stop losses. Otherwise, I might be the one who's right. I don't let go with the dumbs who try to trade with a narrative. And a big range is going to build. In that range, of course, I'm going to risk manage, just like I always do, meaning that when the dollar will find some support, I will risk manage my euro dollar. I've already taken stop losses on the USD GPY, so I'm not going to double down. But the thing is that I'm going to have to risk manage my euro dollar in here, okay? But of course, that means when we get to the opposite boundary afterwards, third range boundary and the like, I'm going to double down on my existing position, because of course I think this will be the huge reversal the dollar could see. Though we're going to have plenty of time to talk about that again in the future, for now we're in a weekly reference and I'm going to need to update these things week by week. Until further notice, we've gone absolutely outrageously stupidly vertical. I think the best case scenario for the dollar is to go for a big range now, which we did already in the past. But I don't think there's too much upside potential for the dollar. But I wouldn't take that bet without stop losses. Like I said, if it goes further, I know that the market can go real dumber, then I could be solvent. So in that perspective, I'm going to take my money out and let the market go dumber and dumber, but I don't follow. Remember that. When you're on the wrong side of the coin, just don't try to flip it. Just go on other parties. There are plenty of other trades out there in the market. If you're wrong on one, just accept it. It's really the way it is. Sorry about that. Just gonna have to restake my daily rewards. Okay, so that's for the DXY. And I think there's going to be a complicated macro situation to navigate, but I think we might have been through the worst. We've experienced so many narratives recently, and it feels like the market is pricing all the worst. We're going to freeze to death in Europe, we're going to default in our credit, and it's going to go just fine for the US. Well, all I say is that it might not be so crazily bad in Europe, and it might not be that pretty in the US either. Remember that November is also midterms elections. Okay, so there's plenty of things to worry about in the US as well. But things will go in time. Last big topic we need to talk about is the silver, where I'm going to go real quick because we're already 40 minutes in. Weekly chart reference in here as well, in a big fat monthly range, though we're trading at the moving average. But like I said, this might look like it's neutral or whatever it is. It looks more like it's a quarterly based range, and it most importantly looked like a good damn structure that I know too much about. It's the cup and handle, meaning that this is a ranging bullish type of market, meaning that once the structure has this big nice rounding bottom followed by a double top, then in that perspective, if there is a significant retracement with kind of another rounding bottom that pays around rising moving average, then boy, the breakout, if it ever occurs, is gonna be nice. Though that means I have some risk limitation to make, because I am in the buy side, and of course I know how much I can make. I need to risk manage the fact of being proven wrong, because I don't know shit about the future. Okay, so that's really what this is all about. I think the reference range is on a quarterly basis. The indicator don't provide such time frames, but still that means I could eventually trade the weekly range. Okay, remember the big massive range. You can't trade range inside a range. You can trade 2 time frames below. So weekly reference time frame would be nice. That's the one we've traded on all the other asset classes in ways. So I think this is really what the market is all about now. Though the quality update we got on our weekly context is no more than we already know. Just like the cryptos, we're already 1 quarter ahead in terms of market consolidation. And in terms of silver, we're pretty much 3 or 2.5 years into a flat consolidation, trading at rising moving average with bullish context detected. We don't have bullish signals in here, but like I said, these are still signals. The moving average is rising and I got them like it. So this is an area in which I said I will buy. So I was studying all of the negative forces pushing us into these supports by looking at 2 to 3 time frames below. Okay. So 4-hour charts. Okay. 4-hour charts, like we stated, 4-hour chart would be trading monthly range, which we do not. And H1 time frame charts. Come on. Yeah, we definitely have some sequence in here. So this is a nice down flow, and nice down flow. Remember, we trade them in odd numbers. So here it is. This is where we create the first third range boundary. This is where we created the second one. And the third one? Oh boy, that's interesting. This one has barely even managed to make new lows. So the market is in a wrong footing pattern. In terms of reversal, this is freakingly bullish. That means the bears are definitely losing strength. Moreover, all of the third range boundaries in the supportive areas are all delayed third range boundary. That means the bulls are late into these calls. So yes, I'm freaking bullish on silver more than ever. This is now one of my most bullish exposition in the portfolio in terms of risk. Like I said, I was willing to take more risks in silver because it is in my big frame for the cycle we're in, the commodity boom following an unperfect but still better than nothing type of model, which is damn it, what's the name? The Armstrong cycle model, in which we would be in a commodity boom cycle. So any commodity, I'm willing to take more risks. So maximum 5%. I don't go anywhere beyond that. That would be stupidly risk-taking. But I'm now 5% risk in the silver. And boy, the further we go, the more I'll put in. Because as I'll be able to reduce my risk and eventually profit take or risk limit by rising my stop losses, I'll be there to catch every retracement on this market. This is probably one of the markets I'm the most bullish about. I've been very patient on silver. I already have previous entries at much higher prices than the bottom. But like I said, I look at the reversal pattern. All I see here is bullishness ahead. So I'm more bullish than ever on silver. I'm not nearly willing to risk manage until we get to the weekly opposite context. Meaning that, in my personal opinion, silver, I have nothing to worry about until we get to 25. That doesn't mean this is just blue sky ahead. There's always risk. And like I said, for now, I don't think it's soon enough for me to rise my stop loss. Okay, so my stop loss is not at the lows yet, but might be the case when we touch the trend channel, and we're not that far away from this. So I'm just patiently waiting, but if silver goes straight line up to 23 or 23 and a like, okay, this thing updates each and every month. So if we get to touch this, this is where I'll be able to risk manage, meaning rising my stop losses at the bottom. And if I can do this with a 5% risk bucket, you can be damn sure that I'm going to have plenty of cash available to rise up again. I'm leveraging this trade and I'm taking some money on the table. Like I said, commodities, in the commodity cycle, I'm willing to take some risks. I wasn't trying to catch the perfect bottom. I was just risk managing my way in by going in there first and then in there and then now in there. And I'm now at maximum risk, meaning that I will not be able to buy if it goes lower. But like I said, I'm following the flow, and the flow has now ended, and it ended the best possible way for me. I know that all the bulls are lagging, and they're going to have to buy a rising market. That's one thing. Of course, like I said, it's not just blue skies ahead. There's one thing that concerns me in terms of silver, and that's basically the fact that if I have a look at the dumb money sentiment, they're heavily buying the silver. So I'm really going to pay a lot of attention week after week to see these things decreasing. I would like to see the retails getting out of their calls in silver as it goes up, because that's what the retails do generally, okay? They buy as the prices go lower, and then they sell as the prices go up. So they basically end up just being wrong-footed all the time. As prices go up, I want to sell them start to sell. Not necessarily meaning that they short sell, but at least they're getting out of their bullish positions. I want them to reduce their net bullish exposition. Otherwise, we're going to have to talk about that again. This is not something that I wish to see evolving on a day-to-day basis, but more on a week-to-week basis. I want to see those numbers hinging down rather than keep on being very bullish. But just a couple of days before, we were there. So as you can see, things change pretty dramatically and pretty quickly. As you can see, silver has a lot of selling activity that goes down and up. So these things will balance over the next few weeks. So just noting this one, I'm paying attention to this on silver, because if the retails trade with me, then that's not a good sign. Okay? I want to see them flip. As the prices go up, they will fear of prices going down or whatever else reason that is. I personally fear nothing because I have signals suggesting I might be aggressive. Therefore, I am. Okay, that's pretty much going to be all about it, guys. I've got one last thing eventually to cover. Damn it, we're already 15 minutes in. Okay, so in terms of raw explanation to the reason why I see different contexts in cryptos that I see in the stock market, I've mentioned it before. I think there's something lying with the S&P 500, and we could see the S&P 500 going down, while the net direction of the crypto might be either slightly bullish or more bullish, but we could see that dichotomy. We've seen it before, in which the crypto market was headed down when the stock market was headed up, and in that perspective, like I said, these things may be the correlation to recorrelation pattern, and if that's the case, there might be something causing it. I've always made it clear, Apple is the liar into this game. Let me be real clear. If Apple goes there and breaks that, that means this was a delayed third range boundary. If that is the case, then that will be the third align on 3 different time frames third range boundary. When that happens, shit is down the corner. Let me be real clear, we're going to double down on the range. So I think minimum target is $90 for Apple if this plays out. So this is the precipice. Apple must not go there. If Apple ever breaks the $133 mark, we're fucked. Because Apple weights 7% of the S&P 500. That means 7% of this goes right net into the S&P 500. And we're not talking about a tiny drop. We're talking about the biggest market cap in the market dropping 36%. And that's the bare minimum to me. Like I said, this is going to be the falling knives type of strategy in which I don't know where the bottom is. All I know is that it's going to be painful. And in that perspective, if the crash ever comes in Apple, this is the stock that has never experienced any such a thing as a bear market. So far, everything has been good for Apple. Like, Apple is so flooded with cash, bro. They're going to survive anything. Even though they don't sell iPhones anymore, everything's fine. Well, like I said, plenty of underlying problem on Apple, and buying your stocks with buybacks isn't one way to just pull them away. It's just one way to delay the problem until they go straight to your face in a single straight line. So like I said, buying share buybacks at the end of a bullish cycle that looks a lot more like a bubble than anything close to rising trends, when the trend terminates, meaning that when there is no growth in the growth of yields, there's going to be a problem. Yields, sorry, not yields. I'll just pull this one out up front, just quick value assessment, okay? When your market goes like that, like parabolic scheming bullshit, okay, there's only one thing that may support this as a value. That means you must see a growth rate in the revenues growth, okay? Meaning that this thing as well has to grow faster, okay? Which it doesn't. It definitely was back then. So this was a moment in which going parabolic was making sense. But even back then, it was parabolic. But, I mean, just look at that. If this isn't parabolic, fuck, what is? But when the revenues does that, I agree with that. I would say value is following this asset. It goes excessive to the upside, but it has reasons to. Now look at this since then. To me, the pivot is definitely 2016, 2017. This is where I started selling the motherfucking Apple because, boy, like I said, this is where we shifted away from value. In my personal opinion, the value of Apple is still there, $50 today. People are paying $150 for this. Like I said, this is nonsense. This is nuts. This is absolute, utterly bullshit. The value is very lower, and if at some point the revenues start to fall, which they very likely will, just mentioning that we might be in a recession. Well, if Apple starts to go down, that means this whole Ponzi scheme is going to collapse on itself. That means all the value shifting we've made thanks to buybacks and irrational expectations of whatever future breakthrough Apple will make by creating cars, VR headset, whatever that is. None of this is there. This is just pure speculation and hype fueled by buybacks. So if these things start to disappoint on the revenue side, you are fucked if you bought Apple at 150. So I really like to make things straight. This is a bubble. I know the shit I'm talking about. So if there is a problem with S&P 500, I think there could be one particular responsible stock for this: Apple and alike. Apple is not the only one in this scheme, but that's the most violent value shifted I've ever seen in my career. So if this thing starts to roll out, it's going to be painful. I don't know how low it's going to get. We could trade Apple at 40. That wouldn't nearly be a problem. And that's a 70% discount on the most pricier asset ever experienced in the stock market history, US stock market history. Okay, so really, really pay attention to this. I see a lot of disparity in the market between the S&P 500 and the crypto market's technicals, and that could be due to the composition of the S&P 500. I've warned you about this for months now, but I think it's due to just think about it as well today, because there is clearly a shift in between the technicals I have on the S&P and the crypto market. We've taken an hour-long video in here to just review all of this, so I've just not invented this. This is truly different. The context might be different, and if the crypto rebounds by the end of the year, the monthly context will not reverse. That means if the S&P 500 goes down, might not be because of the S&P 500. Might be eventually because of the S&P 5. Just the 5 biggest stocks starting finally to take damage when the rest of the market, S&P 495, just does well, or eventually even goes up, just like the cryptos could. So like I said, I don't necessarily think that we're going to get a 180 degree with the crypto market surging to the upside and the stock market falling. But I think what we could experience is a stock market S&P 500 like, more like an S&P 5 going down, but down big, and the rest of the market, cryptos and the like, going slightly up in a boringly recovering uptrend, when both in the end will terminate in the same area. The thing that will happen in between is that those who think that the crypto market will follow the stock market for you to offer the best possible pricings, if that doesn't happen, you're going to have to buy at the mean. So like I said, if you're a long-term buyer, if your plan is to buy crypto for your retreat or whatever that is, if you have a long-term vision for crypto, 20K on Bitcoin is far more than enough. Don't try to be greedy. Too much greed when we're talking about value investing is definitely meaning that you're going to buy at the mean. Really listen to me on this. Of course, that only worth for valuable assets that have already proven their quality, and there are only 2 of them, Bitcoin and Ethereum, okay? Anything else than that is highly speculative and must be with stop loss. But if you're value investing, Bitcoins and Ethereums don't have anything to prove today. They've made their proof of concept long ago. They are valuable assets. If you're willing to invest in these, like I said, if you try to catch the perfect bottom price, you're just going to be left behind. Bye, guys.